Profit, and entire teammates of yours and entire viewers of NDTV Profit, a very happy new year from my side, Niraj, as well.
Thank you. Will it be a happy new year, Manish? That's the large first subset. That will the market stay constructive for portfolios to flourish in 2024?
See how markets can fall. Anything majorly big from where we are today. I mean, you could say that returns could be in and around 15%, but on the positive side, it doesn't look like that you're going to have a negative year. Primarily because of a few reasons. Corporate earnings are still going to be positive. Broadly, Europe has bottomed out. Russia, whatever it had to achieve in the Ukraine-Russia war, seems to be have been done. So you don't have too much of geopolitical issues as well. You would have China incentivizing, and broadly, you are looking at major rate cuts globally. US to begin with, and then it will trickle down to India as well. And then elections behind us will have a political stability also coming through in all probability. So, you could say that, large caps have not done well in the last 1 year. They could outperform in this year. But I would broadly also think that, mid caps and small caps, can also achieve that consensus 15% growth, which is being talked about on Nifty in 2024. I find it hard to believe that 15% returns in the mid-cap and small-cap space, which is so diversified, can be achieved. So I would broadly say ballpark in and around 15% sort of a returns, whether you stay invested in mid-caps or small-caps or the large caps, broadly should be coming.
Manish, for a stock picker, it's always market cap agnostic strategies, I presume, but I heard you say that while large caps might have safety, mid caps and small caps could also do that 15%, and individual stocks, of course, keep on doing well. Just trying to understand if your portfolio bias, despite this whole talk of large caps might outperform mid caps, is your portfolio bias towards the broader end of the spectrum, towards the mids?
I would broadly put it like 50-50, or let's say 40% large cap, 60% mid caps and small caps, because the portfolio is designed to be for more than 3 years and above. And obviously in the medium term, I would broadly believe mid and small caps would give you better returns than large caps. But I think the construct of the portfolio at this given point in time is to have an even keel, both straddling across large caps and mid caps. So I would go with either a 40 to 50% large cap and 40 to 50% mid and small cap.
Okay. I believe the portfolio would have been designed a month or 2 months or 3 months ago, if you will, or maybe slightly longer than that. Come this current period, I know you've designed for 6 months, say 3 years, but a lot of stocks have moved in a week what they wouldn't do in maybe 10 years sometimes. So my question is, have you realigned the portfolio in some fashion because of changes in either the kind of gains that the stocks or the losses they may have made, or the change in the policy or the business environment for that sector or that business from the time that you designed the portfolio until now? Have you had to make some changes?
Yeah, so when we thought about creating a portfolio, obviously some of these themes were in the background. So it was all known that rate cuts in the US would start to come. You really didn't know when they would start to come, and obviously the information technology or the IT space would broadly do much better than what they were doing if you had known when the rate cuts would start happening. So obviously what was an underweight space for the entire market as a whole, suddenly became an overweight stock. And justifiably so, because, looking out into, let's say, fiscal 25 and fiscal 26, and when you compare them with, let's say, fiscal 24 numbers, the numbers both start to look very good. And in that backdrop, the valuations were very, very reasonable, so to speak. So what was an underweight sector suddenly became an overweight sector. Similarly, for, let's say, a pharmaceutical space where not only generic exports are doing well, but even the domestic market, again the valuations were very conducive. So some of these minute changes, I have had to make in the portfolio. than what was the situation, let's say, three to 6 months back.
Got it. And I'll talk about some of these in detail as well, but just broad brush first some of the topics that I had in mind. The other one is, are there any elements in the portfolio which might have near-term implications because of events? For example, PSUs, maybe because of divestment process starting, is there a cap there, or policy changes that may come about? So are there PSUs in the portfolio which you might want to relook at some point of time? Part one of my question is that. Part two of my question is that if rate cuts are coming in, then a lot of people are saying while banks might be the larger overweight, but there could be NIM contraction and therefore there might be smarter ways to play. I'm just trying to understand, are there any event-based or policy-based, policy-impacted sectors having a large weightage in the portfolio?
So on an overall basis, I still like PSUs quite a bit, but PSUs is a very broad, universe, so to speak. So, emphatically bullish on, let's say, PSU banks per se. That is to say that, broadly on account of valuations. Valuations are not expensive at all. And obviously everything is going right for them, more in terms of profit growth, more in terms of, let's say, valuations or deposit franchise, so on and so forth. And on the other hand, let's say the private sector banks. I mean, there's so much of, so to speak, micromanagement that's happening. You can't have this particular CD ratio. I mean, the NIMs are contracting, personal loans or unsecured loans, there is some embargo, so on and so forth. So I think the private sector banks are more headwinded than, let's say, public sector banks at this given point in time. And so within the PSU space, it is the PSU banks where, growth and valuations both seem to be in favor. Defense, I would put it very selectively, because valuations are not that expensive, but they're not that cheap as well. Power, I would still believe that there is room for the upside as far as the PSU names are concerned, more on account of policy impetus. Railways, again, it's a very big universe, so to speak. The overall outlay on the railways sector is going to be huge, but valuations, near-term valuations are, very, very prohibitive.
Just a market-wide question in a portfolio show, but could this happen that if the government starts the disinvestment process, there might be a bit of an upside cap near-term to PSU stocks, because the market may in its wisdom believe that they have rallied quite a bit. Maybe there is a disinvestment or a stake sale or a supply hangover in some of those, if not all. But, pin them with the brush, keep them on the sidelines. We can think of them once this process or pressure is over. Could that happen?
That could happen, but, the market should have a handle of that. Beyond this round of disinvestment, there cannot be any further round of disinvestment.
Right.
If the supply of paper is going to be a continuous one, then maybe, those stocks are likely to underperform. But if the supply overhang, it will go once and for all for a reasonably good period of time, then maybe, those PSU stocks may, after a brief time correction, could continue to rally because the overall environment in that particular sector or space is very good for a very long period. So it depends on at what periodic intervals will the supply of paper come from the government.
Got it. And viewers, we'll talk about specific themes after the break, but before we take that break, one question, Manish: what is the highest weightage in the portfolio currently, and where is it that you would want to increase the weightage in a particular sector, but maybe liquidity or maybe some other technical factors prohibit you from doing that? So I have two questions rolled into one: the highest weightage on the portfolio, and where is it that you would ideally have a higher weightage, but maybe due to one reason or other you don't have that higher weightage on that particular stock or sector?
Liquidity factors, I think some reaffirmation on the growth part. So my highest allocation in the portfolio is in two companies, both in the consumer space, and I'm basically taking a longer term call and buying into these names when the environment for consumption is not going to be particularly good. But the runaway for growth, when you look at, let's say, next 3 to 4 years perspective, is quite good. So this is basically on two consumption names. One is your Kalyan Jewelers, where there's a 10% weight. I think profit growth will be around 18 to 20% for the next 3 4 years. And the second is obviously Zomato, where I believe that again profits are going to surprise on the positive side, and more particularly once Blinkit starts to break even. In terms of sectoral allocations, my higher sector allocations, over a number of stocks is basically your IT and pharma, where I think the risk is to reward is very, very conducive. And the third biggest bet on the sector is basically banks and led towards financial services and PSU banks as opposed to private sector.
Got it. Okay. Well, we'll slip into one. We'll try and talk to Manish about what the rationale behind some of the themes that he has a bet on. Where is it that if he's gotten out or not choosing relative to the markets, why is it that he's doing that? It's important to highlight not just what is in the portfolio, but why is it that some of the things are not in the portfolio. We'll do that on the other side of this very quick break. Stay tuned. Back with the Portfolio Manager right here on NDTV Profit, the first Portfolio Manager show of 2024, in conversation with Manish Sonthalia. Manish, thanks for being on the show, of course, again. Now, I know that having looked at or having spoken to you for years, that you are very constructive on consumption. The question that I have is, a lot of people are of the view that, or at least they have in their portfolios, consumption names which will benefit from premiumization and not staples, and not stuff which has, like for example, you mentioned Zomato ahead of the break. That is not a premiumization story as much as an adoption of a newer habit, so to say. I wonder if your portfolio has names which will benefit from rising per capita and premiumization. Maybe Kalyan falls into that bucket, but is there something else out there? Because there are a few stray stories which kind of fit the bill.
Yeah, so essentially, I'm very positive on consumer discretionary coming back and not so constructive on, let's say, consumer staples, so long as rural continues to be weak. So in that backdrop, both the names that you alluded to, Kalyan as well as Zomato is a play on consumer discretionary. And in a rising global discretionary spend environment, and obviously that's going to be the trend once rate cut starts to happen. It's not only going to be an India phenomenon, it is going to be a global phenomenon and discretionary spend is going to go up. In that backdrop, given the growth, I think valuations are pretty reasonable out here. And, and just to mention out here, even rural, we seem to be turning down the corner. Not a great lot, but, something is incrementally moving positive as far as the rural side of things are concerned. So all in all, not too many sectors to find where, you will be emphatically bearish in these sort of markets. Staples was once such space still about last year, but I think it is all about relative growth which you are pursuing and what price you are paying. So I think it's going to be more about bottom-up stock picking in fiscal 25 or calendar 24, as opposed to a blanket call on a particular sector. That's true till about a year back, but no longer, because some of the valuations are really gone berserk, so to speak, for the near term.
Speaking of consumption, though, the last 2 years on a trot, or maybe actually the last 4 years, if I'm not wrong, autos have given a positive return calendar year to date, right? And this year, as the year ended, even the non-performing auto names came to the fore, auto ancillaries came to the fore, tire companies, because of various reasons, have come to the fore. I believe when I look at your portfolio, the weightages are minuscule or not there in some of these themes. Now, why would that be the case?
Because you're coming off a pretty high base of last year. Let's take, for example, autos. They have done pretty well in the last 1 year or so. And more so on auto ancillary side as opposed to, the OE guys. But if you look at the year before that, autos all in all was struggling. So you could broadly say that if a sector does very well in a particular financial year, then more probability than not that space is likely to be a slow performer in the next year. That's not to say that growth is not going to happen, but it is because markets are all about YOY growth, right? The year previous to that and current fiscal year, the YOY numbers look pretty good. But when you compare FY25 over FY24, I don't think the numbers in the auto space are going to look that brilliant, so to speak. Maybe FY26 over FY25. So there is going to be some cooling off as far as the auto names are concerned, both in the OE space as well as the auto ag space, and the areas that you alluded to could fall in that space. But broadly, that is the reason that there is going to be some sector rotation, even on a year-on-year basis.
In effect, am I hearing you say that in cases like, let's say, capital goods, which will benefit from this whole capex thing, and railways as well, the earnings growth might still remain healthy, but just that the valuation re-rating has been so sharp that you might expect a bit of a pullback there, or stagnation?
I would believe that, the story is well understood. The story is going to last till about 2030 and beyond because of the amount of spend. But, give it some time. I mean, you can't suddenly start discounting 2028 and 2029 and 2030 numbers. The outlook is very good, but, they would require some cool-off. So in that backdrop, I would believe some of the names which have done stupendously well, we all know Tata Motors doubled last year, or let's say Larsen and Toubro gave some 65, 70% odd returns last year. I mean, these stories are going to be good for the next 5 years. But I would believe they would go in for some degree of consolidation.
Some people would say that while you can't say IPOs is a segment because there are various sectors, but the recent listings or the new listings of 2023 have just run amok, and the gains have been very strong. Do you have any of the newer listings there, Manish? Because the valuations in some seem absurd.
They have gone berserk, I would believe, as far as valuations are concerned. It's such a heated segment. Both the SME and all the main board IPOs, subscriptions 100 times, 200 times. I mean, they're just too hot, for us to basically deploy, clients' money in that space. So I have remained totally absent from the IPO space and unlikely to invest unless and until something is reasonably valued and is well understood by me in terms of the company or the composition of the sector. But otherwise, it's a very heated up segment. The IPO market would broadly stay away.
Manish, I've seen a clutch of investors, smart people, bet on some very small businesses as well in 2023. It's always been the case, but it was fairly more evident to me, at least, in 2023. And the premise was that some businesses are necessarily, I mean, they are by definition absent in the larger cap or in cases even in the mid-cap space, because these themes are just getting formed. There are these newer business ventures or newer themes that are emerging. Have you bet on anything which is by definition only small cap? It is not present in mid-caps or large caps. Maybe liquidity might be an issue. Maybe even valuations to some extent might be an issue, but the runway for growth is very, very long and strong.
Some of the emerging businesses like, how would artificial intelligence fit into the small cap scheme of things? Because any new technology adoption happens both at the large cap scale as well as the mid cap segments. It's an area where everything is new for everybody. So, that space is being explored by me, both in the large cap and the mid cap space. Some interesting opportunities could come up. But this is one space where we look to invest in the small cap space, some niche opportunities. But otherwise, other than that, I think the known sectors and spaces, broadly everything is available both in the large cap and the mid cap space. But only new innovation, new technology, etc., are areas where some niche companies may have an edge over large cap companies, and the entire market is getting formed. At that point in time, only it makes sense to look at micro cap or let's say small cap. But I'm looking at only from the technology side of it.
My final question, and I'm taking it to something that you alluded to at the end of the first segment, which is one of your top holdings. Now, the reason I bring it up is usually people say that if you're allocating such a large portion of your portfolio, you look for winners, look for the leaders of that segment. And the leader in this segment constantly, quarter after quarter, speaks about multiple years of growth ahead of it, right? I'm wondering, why is it that you, for example, are not going with the topmost company in the jewelry space, but something which is at number 2 or number 3? Excuse me, I don't quite know the size and the number in whether sales terms or market cap terms of Kalyan versus a Titan, but you get the question that I'm trying to ask you.
Yeah, so, you would be buying Titan at, let's say, a total value of the company at around 3 lakh crores. Whereas for Kalyan, which is, according to me, the second largest pan-India player, having predominantly was a South India player, but now due to change in the business model, they are tweaking the business model to being a pan-India player, moving to studded segment and all of that. You're getting it for less than 40,000 crores. So from a point of view, the size of the opportunity, it all boils down to execution. And I think given the rapid pace of expansion which these guys are doing, and they're in the business of jewelry for the last 50, 70 years, so they understand everything. I think the key differentiation is when HUID was made mandatory. The edge which Tata's had, because of the trust factor, is now available to everybody. Whether it be a Kalyan, whether it be XYZ, it all boils down to execution. The size of the opportunity is available to all. So from that point of view, I think I have better visibility in terms of growth. Not that I'm saying that Tanishq can't do it. They are doing it. And but what is the price that you're paying? I believe that, let's say 2026, Kalyan would be doing 25,000 crore top line and a 4% PAT margin, that should give them broadly around 1,000 crores of profit. And at that given point in time, this company will still be valued at around 50 to 60 prices to earning multiples, which gives it roughly around 65 to 70,000 crores sort of a market cap. And broadly, you will have your stock price double in the next 3 years.
Got it. And viewer standard disclaimer, this is used as an illustration to try and understand how Manish Sonthalia thinks about some of the businesses, purely from a view of how can you and I think about businesses as well. Do not take this as a recommendation, Manish and team.
No, but just a disclaimer out,
Yes.
Both these stocks are a part of my portfolio.
Yeah.
And that is why, we are discussing it openly, but...
no, also you may go out and sell these stocks tomorrow. So there is no holding this per se. So viewers should keep that in mind. But please consider this as used for illustrative examples and not as a recommendation, buy, sell or hold. That's a simple thing. But Manish, so good talking to you today. Thank you for taking the time out and have a fantastic 2024.
Likewise, Niraj. Thank you so much.
Now, the pleasure was ours. And viewers, thanks for tuning into this episode of The Portfolio Manager.